Hi guys, welcome to my channel. Today is May 5th and we are celebrating Cinco de Mayo, or trying to anyway since we can't go out. But I think a lot of people are having tacos at home and possibly some margaritas and maybe Coronas, maybe not. Now it doesn't matter what kind of drink you're having. If you're watching my video, I hope that you can find this useful, or if you want to share it with friends that can find this useful, you do so. I really do put in a lot of work into this video. As of now, we're still under quarantine. It looks like we will be under quarantine for a little bit longer than expected because the state of Illinois rolled out some milestones that they want us to hit before we get there, and we are still not there. Now, the reason why I'm giving these updates is not for you guys because you guys already obviously know what's going on. I'm doing it for future generations who might be watching this video. I do hope that I have grandkids and maybe they'll watch it sometime and look at their cool grandma. But if not, it's always useful. I mean, it can't hurt. Now, the reason why I'm making this video is to answer some questions that I had regarding the two previous videos that I made. And these questions were submitted by people who watched the video. The first question that came out is it a good time to invest in real estate? Now, I believe that it's always a good time to invest in real estate because there are always deals. You just have to find them. I think that the question was relating to whether it is a good idea because of the way that the coronavirus has affected the economy. I think that if you are willing to take the risk, you should do so. Again, if you're financially stable, or if, say, you're renting a house and you'd rather buy a house, it's definitely going to be beneficial to you. Now, I know that some people think that the housing market may crash, and that may be so. We hopefully don't want it to crash, just because if it does, there's going to be a lot of people who are going to lose their home, and that's not something that we want to see. But if it does, the houses will be a little bit cheaper. But honestly, if you are ready to buy now, there's really no reason to, just because your house is not going to lose value. The houses here in Aurora are actually not that expensive compared to other places. So I think that it is a good opportunity to do so. Now, the reason why I think it's also a good opportunity to buy here in Aurora is because of all the changes that have been going downtown. So bottom line is, yes, you should invest in real estate if you have the means to. The next question that I received is, how much house can I afford? Now, this is going to be a little tricky question. Usually, if you fill out a pre-approval letter, like I said in the previous video, your lender will tell you exactly for how much you qualify for. Now, if you are nervous about contacting a lender and you kind of want to do your own research before you go in, what you can look at is your debt to income ratio. So it's a calculation that most lenders use that helps them determine whether they will loan to you or not. And what they do is they take everything that you owe per month. So that's any insurance, any car payments, cell phone payments, anything besides rent. And then you're gonna take that and divide it by your gross income. Your gross income is how much you make before taxes and before anything else is taken out. So for example, if your total bills per month are $600 and you make $1,200 a month, so you take $600 divided by $1,200, that gets you to 0.05. You multiply that by 100, which is 50%. So your debt to income ratio is 50%. That's pretty high. Most lenders want you to be below 43%, and actually some lenders will actually want something way less than that. And that's something that you're going to have to talk to your lender about. Obviously, things might have changed with the whole virus, so definitely contact your lender. This is just like an easy way to kind of gauge if you should even apply. The next thing that you want to do after you think that your debt to income ratio is good and acceptable, what you can do is actually you can go online to realtor.com, and they actually have a mortgage calculator, or how much I can afford calculator. Okay, so say that you've done the calculation and you don't like what you see. you still have some options. The first option, which is very limited, is you can increase the down payment. Now, increasing your down payment can maybe help you out if the difference between what you qualify for and how much the house is worth is only by a few $1,000s. Just because if, say, you want to buy a $120,000 home, but you only qualify for a $90,000 loan, you're going to have to put up the difference, and that is a lot of money. The next thing that you can do is get yourself a cosigner. Obviously, you want to make sure that this person has good credit, because when you run the application, they're going to take both of your credit scores and they're going to take the lower one. You want to make sure that this person is financially responsible, because their credit can affect your application. Now, you also want to make sure that you are responsible, because even though this person is not on the deed, they are financially responsible for your choices. So if you cannot afford to make those mortgage payments, they're going to have to do them for you, or it's going to go on their credit line. Now, the last thing that you can do is to increase your income. Now, I know that increasing your income sounds easier said than done, but what you can do is find another part-time job, or maybe take opportunity of extra hours or overtime that are available at work. And obviously this is going to take a little bit longer, but that's why I think that, you know, when you want to buy a house and your sources are limited, you should definitely start planning way before you actually want to buy it. I know that sometimes people come to me when they need to move out, you know, within the next couple of months, and that's definitely not doable, just because closings can actually take at least 6 weeks. So you don't want to buy a house because you have to move out. All right, moving on to the next question. The next question is, what is my mortgage payment going to be? Now, if you already have your pre-approval and your lender has already talked to you, they will actually tell you how much your mortgage is going to be roughly when they give you the pre-approval letter. So they'll say, hey, you qualify for $150,000. Your payment's probably going to be about like $1,100, you know. And now, factors that can affect this is obviously how much your house is worth. Second factor would be how much you're putting down. So if you have a larger down payment, obviously your mortgage payment will be a little bit lower. The next thing that could affect it would be your taxes. Now, everybody has different taxes depending on if you're using any exceptions. So there is such thing as a homeowner's exception, where you get a little bit of a discount if it's your primary home. Or for senior citizens, they have a discount on that. So if you're purchasing a home, you want to make sure that you take a look to see if there's any exceptions that have been applied to the taxes, because those exceptions might not qualify for you. The next thing that's going to affect your mortgage payment is your insurance. Now, you can also get a free estimate from any insurance agent. They will give you an annual premium, and then you're going to divide that by 12 and then get your number, and you're going to add that to whatever your lender is going to charge you. The next thing that's going to affect your payment would be if you have any private mortgage insurance. Private mortgage insurance, or PMI, is used for people who haven't put down the complete percentage that the bank wants, and for all FHA loans. Now, usually it's pretty small and it's already included in your mortgage payment, so it's not something that you have to worry about. Something else that you should think about is when you're checking out a house is if it's in a flood zone. Flood zone insurance is separate from regular insurance, and that's something you want to look into, just because obviously if the house is in a flood zone, it means that it has a higher chance of getting flooded, and obviously the insurance agents don't want to take those kind of risks. That's why there's an extra insurance attached to it. The last thing that you have to think about is if your house has something called HOA fees, or homeowners association fees. This also is very common when you're buying a townhome or a condo. Sometimes they include landscaping, they include sometimes it's snow removal, or they have other cool things like maybe a gym. You want to make sure that when you're putting an offer in that you're aware of those costs, just because those costs don't change and usually they are billed annually or monthly. You want to make sure that you also consider that into your budget when you're looking for homes. Now, the last thing that is factored into your mortgage payment is your interest rate. Now, right now, interest rates are really low, and you have to keep in mind that your interest rate is based on your credit score. So if you have a good credit score, then more than likely you're going to have a really good interest rate. Now, it can make a huge difference. It can be like up to a couple $100, even $50 a month that you can save depending on how many points you get when you're applying. So make sure that you talk to your lender about it. They can break it down to you, because even when you're buying a house, say that you don't like the interest rate, you can always buy it down. And again, just a disclaimer, I'm a real estate agent. I am not a lender, but this is just information that I want you to have so that when you are talking to your lender, you have an idea of what you need to know or what your options are if they don't mention them to you. Moving on to the next question that was submitted is, how long do I have to keep my down payment money inside my bank account? Now, usually your lenders are going to want 2 months worth of bank statements and pay stubs. So they want to make sure that the money that you're using for your down payment is coming from a traceable source. And also they want to make sure that you're not getting a loan to cover your down payment. Just because if you can't afford a down payment, then it's going to be probably hard for you to afford a down payment loan on top of your mortgage. And they're doing this just to make sure that you don't have any issues in the future. Thank you guys so much for watching. If you guys like the content, please hit the like button and subscribe to my channel. Please also share the video if you think somebody else would find it useful. You can also follow me on Instagram, Nayeli Sells Real Estate, on Facebook, Nayeli Sells Real Estate, and I also have a website you can go to. It's nayelisellsrealestate.com. You can also leave comments on the bottom and I can answer any questions on that. I really do appreciate that you guys are taking the time to watch the videos and give me feedback. I am trying really hard to make these videos a little bit easier to follow, and I'm training myself to stop saying but public speaking is definitely not one of my strengths, but I wanted to make these videos to help you guys, guide you through this process that I know it can be a little bit difficult, especially if you don't understand a lot about finances. Again, thank you guys, and I hope I see you guys soon.